Japan is well known as one of the United States' greatest allies. This extends to their economic, military, and political relationship with each other. But there's also one more aspect where their relationship extends to, and that is debt. The United States is known as one of the world's largest holders of government debt, and one of the largest, or in fact, the single largest foreign owner of US debt is no other than Japan. Here's a graph on the largest foreign holders of US federal debt by country as of December 2023. Here you can see just how far ahead Japan's holdings of federal debt is when we compare it to other nations. Here you see that Japan holds over $1.1 trillion, which is hundreds of billions more as compared to China's $816 billion. That is the same for any other major American ally. So, this raises the important question: why does Japan own so much US debt? Why don't countries like Germany, France, or other major US ally do the same? Well, to understand this, it is first important to know what US debt is. US debt, or basically how the US government funds its spending, is done partly by issuing Treasury securities, bonds, bills, and notes, that promise to pay holders a certain interest rate over a specific period. Investors, ranging from individual people to major central banks, purchase these securities to earn interest while expecting their principal to be repaid at maturity. Now that we have an understanding of what a US debt is as defined by Treasury securities, let's now understand how Japan became the largest holder of US Treasuries. Japan's purchases of US Treasuries is correlated with their economic success. When Japan's economy underwent a miracle after the Second World War, what came along with it was leadership in certain categories and enormous exports. Japan in the 20th century, and even in the 21st century, emerged as a key leader in automotives, electronics, and machinery. This leadership helped them export millions to billions of dollars worth of goods to all across the world. That is why Japan is so well known for their car brands like Toyota or their camera products like Sony. This export would result in what is known as a trade surplus. A trade surplus happens when a country exports more goods and services than it imports, resulting in more money flowing into the country than going out. Japan, being a global export powerhouse, consistently ran large trade surpluses. This surplus created a significant accumulation of foreign currency, primarily US dollars, since international trade is often conducted in dollars. Here's a graph on the trade between the United States and Japan, just to show you how much surplus they were getting. The graph that you see here shows the trade balance between the two economies. If it's negative, it means Japan is exporting more to the United States. And if it is positive, it means that the US is exporting more to Japan. But as you can see, there is not a single year where the US exported more goods to Japan than it imported. This resulted in the surplus that we just talked about. This surplus results in an influx of money. And of course, Japan can't just put this money in the bank, right? If they did, it would sit idle and not generate any returns. Instead, Japan uses these funds to invest, and one of the safest and most reliable investments globally is US Treasury securities. These investments allow Japan to earn steady interest while keeping its funds in a secure, liquid form. This strategy not only preserves the value of their surplus, but also strengthens their financial relationship with the United States. Hence, Japan purchased US Treasuries. Here's a graph showing the holdings of Japan in US Treasuries from 2000 to 2010. Here, you can see just how much US Treasuries they were holding. In 2004, it amounted to more than $689 billion. This wasn't a small amount, as we shall see. Here's another graph on the composition of foreign holdings of US Treasury securities. Here you can see that in 2004, Japan held approximately more than 30% of all US foreign Treasury securities. Put simply, for every dollar of US debt held by foreign countries, Japan owned more than 30 cents. This made Japan a critical player in financing US government spending, and their holdings only grew larger over time. But surpluses may not be enough to actually show the entire picture. So, let's graph out the total reserves of Japan. Here you can see the total reserves of Japan, data from the World Bank. What this data reflects is the scale of Japan's accumulated wealth, particularly in foreign currency reserves. These reserves are a direct result of decades of trade surpluses and smart financial management. In the early 2000s, Japan's reserves skyrocketed, and this is the result of those surpluses. Now, let's talk about why Japan invests in US Treasuries. We briefly mentioned earlier how investing in US Treasuries pays interest and is in a secure, liquid form. That is amongst the key benefits of investing in US Treasuries. But, for Japan, a big reason for them investing in US Treasuries is because of the fact that Japan has very, very low domestic interest rates. Here's a graph on Japan's interest rates. Here you can see just how low interest rates are in Japan. They are even negative in some years. What this basically means is that for people who are living in Japan and saving money in domestic banks, the returns on savings are minimal or even negative. This would then force Japanese citizens, as well as Japanese banks, pension funds, insurance companies, and other investors, to look abroad for better yields. What better and safer way to invest it than US Treasuries? Let's compare this mathematically. The domestic interest rate in Japan is 0%, sometimes negative. Comparatively, the interest rate in the US Treasury securities has historically been much higher. For instance, even during periods of low global interest rates, US Treasuries often offer yields of 1 to 3%. While this might not sound a lot, it is significantly better than earning nothing, or even losing money, on savings in Japan. For large institutions like banks and pension funds managing billions of dollars, even a small percentage difference in returns is highly impactful. In total, the $1.1 trillion holdings of Japan could earn anywhere from $11 billion to $33 billion annually in interest, depending on prevailing US Treasury rates. This reflects just how much better it is to invest in treasuries than in zero interest rate Japan. Now, of course, this reason may change in the future. As we saw in the earlier graph, the interest rate of Japan has started to go up. Let's see the graph again. Here, you can see that there's an evident increase from negative 0.1% to 0.25%. Even though it may seem like a small increase, it would still have a noticeable impact on investment strategies. Another one is the fact that Japan's 10-year government bond yield has increased. Here's a graph on that matter. Here you can see that the yield has steadily risen. From 2016 to 2020, Japan's 10-year government bond yield was less than 1%, but as for the latest data available as of the time of writing, it has risen to over 1.2%. Just like interest rates, it seems small, but it would still have some form of impact in investment strategies. One last reason for Japan's investment into US Treasuries is because of the need for managing their exchange rate and looking for stability in their national currency. As an export-driven economy, Japan benefits from a yen that is relatively weaker against the US dollar, making Japanese goods cheaper for American consumers. When the yen strengthens too much, it can hurt Japanese exporters' competitiveness. The Japanese Ministry of Finance and the Bank of Japan can influence currency markets by intervening, buying or selling the yen to slow down rapid fluctuations. One subtle form of managing the exchange rate is through the purchase of US dollars, and then investing those dollars into treasuries. This practice increases demand for US dollars, which can keep the dollar strong and the yen weaker. And it allows Japan to accumulate dollar assets that can be used strategically if the yen experiences upward pressure. While direct foreign exchange interventions are less frequent than they were decades ago, the net effect of consistently parking trade surplus dollars into US treasuries are somewhat similar to maintaining a steady balance in the currency market. Finally, it is important to know that while Japan is the largest holder of US debt, they were actually briefly overtaken by China. Here's a graph showing the difference between Japan and China. Here, you can see that China actually overtook Japan's top spot as the largest foreign holder of US treasuries. But in the past few years, Japan had reclaimed that spot again. This, however, shows just how surpluses and reserves can influence a country's ability to invest in foreign assets, like the US treasuries. China's brief overtaking of Japan as the largest holder of US debt was primarily driven by its own economic growth and trade surpluses, particularly with the United States. However, geopolitical tensions, trade wars, and China's desire to diversify away from US dollar assets led to a reduction in its holdings, allowing Japan to reclaim the top spot. So, as you can see, Japan owns a lot of US debt for many reasons. But anyway, do let us know what you think. Thanks for watching.